Yeah. So good morning, welcome, and thank you for coming to this industry session, especially after last night amazing dinner. So I have the pleasure to introduce you to Ramit Sawhney, an engineer manager at Tower Research Capital and a research associate at the Georgia Institute of Technology, AI Institute of the University of Southern Carolina, and the University of Marburg. Ramit's primary interests across his industrial and academic roles lie in quantitative finance, natural language processing, and deep learning. Ramit's work in these areas has been presented at top-tier NLP and AI conferences, including ACL, EMNLP, NACL, AAAI, CIGAIAR, a lot of more top-tier conference is very difficult to pronounce. So Ramit also serves as an organizer, reviewer, and host across a wide variety of industry-focused research initiatives and conferences. Ramit started his career as a software engineer at Tower Research Capital after completing his undergraduate studies, and since then has focused on building technical infrastructure for financial use cases. So today, Ramit is going to speak about natural language processing for industrial financial predictive analysis and stock trading. So the floor is yours. Let's see.
Okay, so thanks everybody for coming in. Again, it was difficult for me to wake up after yesterday night, so I can imagine it's very difficult for you to wake up. And if I wasn't presenting this, I'll be honest, I probably would be very late myself. So thanks for coming. And here's a brief agenda of how we'll do this. So the goal here is not for you to see any fancy diagrams or math formulae on the slides. They might have some, those are just for reference. The goal here is I want you to leave with 3 takeaways, which you'll learn by the end of this presentation. Those are 3 very simple takeaways that have led to, I'd say, most of the work that I've done, whether it's in quantitative finance or just in NLP in general. And with that, we'll first spend a little bit of time going over a brief introduction, an introduction of, well, me. You should know who I am if I'm giving a talk, so you should know what I do. Also, the kind of research I do and what got me there. Then we'll talk a little bit about financial markets and some context around that. Personally, I work in the finance industry using natural language processing. So we'll talk a little bit about what is the financial industry, what kind of problems we solve. Don't worry, it's not going to be very boring even if you don't know finance. The applications are pretty much parallel to, say, user modeling or general NLP. We'll then talk a little bit about financial NLP specifically. So the goal here is, how do we make money? When I say money in the industry, this usually is the order of billions of dollars. How do we make that using natural language processing live in production as of today? So probably some financial NLP strategy is running right now as I speak, back in New York or in India or whatever, and we'll see some of those algorithms here. Then we'll talk a little bit about what happens beyond NLP. So I think we've spent a lot of time talking about text in general throughout the conference, but we learned that there's more to AI, finance, or, well, pretty much any field beyond just text. So we'll kind of talk about how to contextualize text in different aspects. These could be across multimodal contexts, hypergraphs, not very complicated. I'll try to explain this from a very beginner-friendly perspective. But the goal here of the entire talk is to understand, how do financial markets work? What kind of algorithms do we use to make money in the industry? And probably the most important part, how do we contextualize or make meaning of this language using other data sources? And how does that kind of translate to what I would call maybe newer methods in academic research? At any point, feel free to ask questions. Perhaps we can take them in the end, but feel free to interrupt me anyway. So a brief introduction about me. I'm not going to read through everything here, but this is just to give you a sense of who I am. So I finished my undergrad back in 2018, which feels like a very long time ago. I feel like a dinosaur already. And since then, I've been working at a high frequency trading firm. So let's break down what high frequency means first. High frequency means that we do trades, or we have code that runs or buys or sells stocks, cryptocurrencies, options, bonds, basically anything that you can buy and sell. We buy and sell that at a nanosecond latency, which means that in the time that I've begun this talk, we've probably, and when I say we, I mean any company that does this. So basically everyone on Wall Street has already traded more than $1 trillion in the last 2 to 3 minutes. And the whole goal here with high frequency trading is you want to build systems that can make sense out of a large amount of data. What can this large amount of data be? It can be news information. It can be, it can be social media information, speeches, videos, basically everything that you see in the world somehow affects the financial industry. Pretty much like, for example, say, if I talk about, say, a hurricane that comes in a desert in a remote state in the US, you might think it's not going to have an impact on the stock of Apple or Google, but it will. And the whole goal is, because everything affects the stock market and, well, practically everything in the world, the idea is, how do we use all of that information in the quickest possible way to make the most money? That's a broad problem statement. And I've been working in Tower for the last 4 years, so pretty much since I finished my undergrad. And as a side hobby might be a strong word here, but research has been a side hobby. In a way, it's not very correlated to the job. What you see in the financial context column is what I do as part of my day job, which includes building these algorithmic models. So basically neural networks that can automatically do stock trading. And I'll explain what stock trading exactly means. Besides that, my primary research area focuses more on social media and user modeling. So that's very relevant to the keynote that you saw yesterday from Professor Lucy. So she's one of my collaborators. Mentor is probably a better word. And we focus more on social media and user modeling with her. The reason I mentioned social media and user modeling here is, so when I started working in the financial domain, I think about 3 or 4 months later, I realized that the same methods that work for finance, exactly the same, no modification. If you just plug in a user-oriented data set, it works pretty well. When I say pretty well, it means it beats SOTA. It means it reduces bias. It means it runs faster. So I'm not comparing humans with stocks or the financial market. What I'm saying is that social media or web-based user profiling models are synonymous to the financial models, and you'll see how very soon. The last spectrum of my work, which we'll talk about towards the end of this presentation, is around, if you have language, right? Imagine the difference between you reading a transcript of this keynote at home versus you seeing me in person and hearing it from me here. I hope there's some difference to it. If not, I'm doing a horrible job. But in case there's 1% of a difference, it elaborates that multimodal context is a thing, which means that when you read something, it at times is more effective to also hear it, maybe with the tone that a person has, the pitch, the voice modulation, or in fact, seeing something. Personally, I don't read books. I prefer watching movies. And the reason why that is there is because multimodal context helps. So we'll talk a little bit towards the end on what is this multimodal context, how it comes into the picture in the financial world and, well, in general. And then end by not even talking, but leaving you with some, not just takeaways, but some ethical questions that come in the financial industry. So we make, I shouldn't say we because I don't get a lot of it, but the industry makes a lot of money. And then there are a lot of ethically interesting points that academia brings up, which we don't really tackle very well in the industry. So it's my most recent work in NACL this year is going to be focused on bias elimination and understanding how the financial industry probably has a trade-off. There's something like a money profitability versus ethics trade-off, which you can quantify and model in a neural network. And we'll conclude with that. So I'll leave you with some ethics related questions, and those are very interesting future directions to build on. So with that, let's talk very briefly about what are stock markets. Maybe people know here, maybe some don't. I've learned in my last research visit to Germany that a lot of people don't, but in India or the US, it's I think, pretty common thing where people normally invest whatever spare money they have in a way. In a brief sense, the graph that you see here, the only reason it dips is because of COVID, where the markets went down. Markets are pretty much fluctuating all the time. When I say fluctuating all the time, I mean, again, trillions in a second. In 1 second, more than $1 trillion go from one person or one company to another. And what that means is that there's a huge amount of opportunity. Opportunity to make money, lose money, invest money, basically build new products. Today, if you go and see how many new startups are coming up, that's only a tiny fraction of what kind of opportunities are there in the stock market. So stock market is a huge amount of money that basically, well, it's you can even call it a gamble if you don't do it well, right? I buy a stock. Right now, I buy maybe say 1 million worth of Apple. Say if I bought 1 million worth of Apple stocks 10 years ago and I kept them, I don't even know what it'd be worth, maybe more than $1 billion today. So it presents a lot of opportunities to make a huge amount of money, but it's obviously easier said than done. Had it been, then, I'd probably be rolling in the money right now and not giving the talk here, but you definitely, so it's definitely difficult, and we'll talk about how difficult it is. But in a nutshell, the market is dynamic. And when I say dynamic, I mean at the latency of nanoseconds, which means two things. One, you need to rapidly respond to news. For example, if a news comes right now that, okay, everyone here uses Twitter. Some people use Twitter. Anybody? Okay, somebody says yes, fine. And you know who Elon Musk is? I'm assuming you do. And the moment he tweets something, you will, if you follow the markets, then you know. If you don't follow the markets, then I'll tell you that, say he tweets something like, I don't know, say he tweets something like, this company is shit. I won't name the company because this is being recorded. But let's say they say that he says this company is shit. That company loses billions in the next few seconds. If he says, there's a random stock coin, it's called Dogecoin. I don't know if people know that or not, but there's a meme with a stupid looking dog. I was lazy to find a picture, otherwise I'd put it in this presentation. But there's a meme with a stupid looking dog, which was basically valued at nothing. In 1 year, it now values, I think, in millions or billions. So people who made it, they put in maybe like 1 cent, and they're now millionaires. And this is like a different world. So when I learned about all this, initially I was like, why do I even care about this? But apparently two things. One, you make money, maybe. And the second is academically, it's interesting. There are lots of interesting research opportunities that this brings you to. So with that being said, let's quantify this a little bit more. So like I've said, stocks are bought and sold at prices that change dynamically. Think of it like this. Every stock, the stock, option, future, cryptocurrency, coin, everything basically follows a time series. And the time series means at every nanosecond, the price changes. It either goes up or it goes down. If you correctly predict, it's a binary classification problem. It's as simple as that. If you correctly predict that it'll go up, then, well, you've made a lot of money. If you incorrectly predicted, you've lost a lot of money. It's as simple as that. So essentially, given a time series, you need to predict if that time series will go up or down in the next 1 nanosecond. Pretty much that's the entire problem statement. So a different way of measuring this, the formula here might look complicated, but it is just a log of the standard deviation, which means we're basically trying to measure how much does a stock move. So if a time series moves a lot very, very quickly, it means it's more difficult to predict. If it's a pretty, if it's like an increasing straight line, you just assume and say, if I buy this, I'll make more money. Now, what I'm showing here in these two graphs, on the left is first a pretty famous financial crisis in the US and the world, I think, global recession, on the right side, you see the more recent COVID-19 pandemic. You would think these are bad things, but there are people who make a lot of money out of this. I might be overselling this here, but the COVID-19 and 2020, the year when COVID actually had its biggest impact, was the most profitable year for every Wall Street firm. Everyone made more money than they have made in the last 4 or 5 years. Why did they make that much money if the world is going to hell? Well, there is that much money, and you don't need to hope that the market does better. You just want that the market changes. And if you correctly bet that this person is going to lose money, you're going to make a lot of money. So essentially, financial risk basically means how quickly does a stock's price change? And our goal is that we correctly predict if the price is going to go up or down. Which brings me to a very famous phrase called a risk-reward trade-off. It's a thing in life in general. The bigger risk you take, the bigger reward you could get, but obviously you could also lose a lot. So the volatility here, this standard deviation, the higher the volatility, the bigger the chance you have of making a huger amount of money, but also on the other side, you have an equal amount of losing all of that money. So in today's talk, we'll talk about 3 different papers that I worked on. Which talks a little bit about the methods to kind of predict and make this kind of money. No disclaimers. If you lose money, it's on you. Don't come to me. But and if you make money, obviously some of it goes to me. That goes without saying. So we'll talk about some of these methods, but try to keep an open mind where these methods are not just for the financial problem. Think of it from an NLP and a user-oriented problem, and I'll show you how that happens. So we'll talk a little bit about why this stock future performance prediction, I guess, is challenging because, well, there are lots of different sources. So social media is one, Twitter, Reddit, whatever, financial news, any newspapers, talks that happen, the weather, basically anything that you can think of, it affects the financial markets. Pretty much like how it affects users like us. So say it's a very gloomy day, you might end up saying something on social media. In fact, I was checking Twitter just yesterday to think of an example to say here, and magically I found something. And someone was saying something about NLDB. So you could go and search, I won't name who, but someone mentioned something about NLDB and then say, Positively that it's great sunny weather. It depends on who's listening to it though, because it is sunny. So I'm not a fan of that, but well, I think most of you here are. So they were very happy that it's very sunny. And then somewhere I was reading about weather and they were mentioning about a different conference where it's very gloomy right now. So they're affected by it. So similar to that, every stock market also reacts to the weather and basically everything that you react to. So say a depressing news comes in, like say a war, you're going to get affected by it, right? You'll go and post something about it. Similarly, the stock markets will change. For the stock markets, obviously, it's a good change because people will make money of any bad news also. But effectively, everything that affects stock markets also affects users. So we'll draw parallels when we look at the neural networks on how this can be used for user modeling, well, any NLP task in a nutshell. We'll talk about a time series of text in a way. So I described that a stock basically has a time series of price data, similar to, let's say, your Twitter posting history. If I go on my Twitter right now and I look at all the posts I've made over time, what is that? It's a time series, an irregularly spaced time series of all the, like a bunch of text that I've posted over time. And that's similar to a stock market where, you know, irregularly the stock price keeps changing. We'll talk about how to formulate this in a ranking problem rather than just classification. And then we'll go over, well, I think what you'd be interested in is how much money does this actually make, right? So we'll talk about that also. So here's the, well, one example of Elon Musk and what it does. Obviously, there are more examples of this, but this is just one tiny example of the impact that a single tweet can have. So what you're seeing on the figure on the right is basically a bunch of tweets that came in on 1st May 2020. These are about a stock called Tesla. So I think most people would know it here. So the goal is to make rockets and self-driving cars and whatnot, and is doing really well as a company. Elon Musk, basically the CEO of the company, one day says that, well, you can pretty much read what he says, that the stock price is too high. The moment he says that, within minutes and hours, his company's value goes really, really low. So what I'm trying to show here is that even one text on social media can influence these models significantly. Now, who this text is from, what kind of sentiment it has, etc., is the whole natural language processing problem over here. Over days, he shrunk his company's value by 14 billion. Why he did that is a different thing. We won't get into that, but he did that on purpose as well. So the whole idea here is that unstructured text online, kind of like, well, social media, any text that you people deal with, not very structured, news articles, social media, voice recordings, all of this is pretty, well, to summarize, it's chaotic. It is variably influential, which means that not every text has the same influence towards a certain problem. Some are more important than the others. These exhibit sequential contextual dependencies. That's a fancy word for saying it's a time series. And they rapidly influence these stock prices. So now let's break it down. What is our goal? We have a time series of text. Text can be tweets, posts on social media, anything you can imagine. We have a time series of all of this text, and I need to make a prediction on the basis of this time series. So let me draw a parallel here with something like fake news. If I have a certain user on Twitter and I want to predict if they are a fake news poster or not, the best way to do that is if I sequentially look at all the tweets they've posted on Twitter and put it through some kind of model and make it predict binary classification, or well, whatever formulation you want. So this is pretty much the same thing. You have a bunch of text over time and you want to do any kind of prediction. Here, the prediction will be, will the price go up or down? Pretty simple. So instead of price classification, the diagram here might be complicated, so we won't dive too much into that. But instead of price classification, a better way of reframing the stock question is, or well, reframing any user modeling question. So anyone who works on user modeling or text classification, sentiment analysis, well, I think everyone does here. Think that instead of classification, if you ranked, would it be better or would it be worse? So with stocks, it makes sense to rank. When I say rank, it means instead of just saying which stock's price will go up and which stock's price will go down, rather, I would like to generate a list which says that the number one item on this list, if I invest my money in that, I'll make the most money. Kind of like saying in the fake news problem, instead of saying, is this fake news or not? I should rather say which of these 10,000 articles is the most problematic or is the most concerning or the most likely to be fake news, something like that. The reason we want to rank specifically is because we have limited resources. Resources for stock trading means limited money. Say I only have 100 euros and the list gives me 10 stocks that all 10 of these will do well. If I equally allocate $10 to each, 10 euros, sorry, to each, versus if I say put 90 euros to the most high performing one and then 10 to the rest, I might make more money if I don't allocate equally. Similar to say fake news, right? If you do fake news moderation or a different thing that Lucy might have spoken about yesterday, so suicide ideation moderation, where the goal is to track mental health on social media. In these cases, you can't just let the machine do everything. The machine can be a primary filter or classify, and then you have a human moderator who analyzes that the person is going through some kind of mental distress. In such a case, ranking is more helpful. Why is it more helpful? Because you only have a few human experts and you have billions of posts on social media. So essentially, ranking these makes more sense. The ranking problem is very straightforward. Again, you have a time series and you have a bunch of different options where earlier you were going to predict for every single stock. So stock A, B, C, D, this could be user A, B, C, D here, where the goal is to predict if the stock price will go up or down. Rather, we say instead of predicting just up or down, you should also rank based on potential profitability. That's the broad goal here. Now, this might look like a big jump and you might be wondering, how did I go from here to, well, this diagram here? But it's a very simple diagram if we'll break it down one by one. So let's start from the left. On the left, you see the representation of every single stock. So this could also be a user. I keep saying user because I feel that might be easier to understand. So on the left, you S1, S2, S3, these are different stocks. And they're basically one-dimensional vectors, arrays, you can say, where every dimension represents a single day T. So basically what's represented on the left is a time series of every stock, a time series of all the posts. It's kind of like if I go on my Twitter or say LinkedIn feed right now and pick up all the posts, concatenate them, that's what is on the left. After that, you encode these using, say, BERT, or whatever encoder you would like to encode them with. In our case, we did it with BERT. Now, because we know this is a sequence of text, it's pretty natural to feed these into a sequential model like an LSTM, for example. So it's similar to the words in a sentence, right? You feed the words in a sentence to an LSTM to predict something about the sentence. Or now let's go hierarchical. Rather, if I say, now I feed every single sentence in a paragraph to an LSTM, and then every word in that sentence to another LSTM. That's kind of what's happening here. I take the time series of all the stock related texts I have, feed those into a sequential model. The sequential model has some kind of attention. The attention is to focus on the more important days, kind of like this example before, where although there are so many different tweets, you'll see that there are certain ones, the ones in bold, which are more crucial or more evident. kind of like saying there's a lot of garbage on Twitter or social media and in the world in general, at least online. And to be able to filter out from that, dealing with huge amounts of data, you require something like an attention mechanism. So in our case, we also feed in. Now, this is where I'd say this paper, you can call this paper novel in a way. I'd say this is pretty much the reason why it got accepted into EACL as well, was we don't just feed in the sequence. The place where this differs from natural language processing a bit is that we also have the timestamps that are associated with every single post. So kind of like if I go on Twitter right now and I look at, say, the posts about NLDB without looking at the timestamps. Maybe there are certain posts about NLDB. Well, it didn't happen last year, but whenever it did happen, maybe there are certain posts that say something like the food wasn't great, right? I'm not talking about this year. This year was great. But let's say someone says the food wasn't that great. Naturally, right? Because we have the best organizers are here this time. So maybe it had worse food the last time. But if you don't factor in the timestamp information and you feed this to a sentiment model, it's going to bring your sentiment model score a little lower, because it'll read that, well, some of the food was great, some of the food wasn't great. Now, if I feed in timestamp information, so in this case, years, but in stock markets, this becomes important at the nanosecond latency. So we need timestamps to be put in. Now think of the LSTM again. When you model anything in an LSTM, you feed it, you take a sentence, like let's say this sentence, financial news and whatever, tweet-based, whatever this is. I tokenize this, I feed every single word into an LSTM, and then the LSTM predicts something. Now, an interesting thing is, why do I feed it to an LSTM? So that it can keep track of what was the word before and after, maintaining the sequence, basically. Now, when I look at any kind of online data, whether it's social media, tweets, stock data, it also has time. So I not only need to know what was the last item in the sequence, I also need to know how far back it was in time. If the past tweet about NLDB was 2 years ago, I know that it's not very relevant to me. Now, this could also be a pre-processing step here, where you could say, why do I need a network to do it? I can just say anything before 2 years doesn't work. But think about stock markets or user modeling. There it's seconds. You can't draw a hard-coded constraint and say anything after this is not relevant. So I say something like, if it's a tweet about NLDB which says the food was terrible 2 years ago, well, not very relevant to how NLDB was now. But if I don't factor in that timestamped information, then, well, someone sends Paolo an email, right, that I'm hearing NLDB had horrible food, fix it next time. So that's kind of the agenda here. And the closer the past item in the sequence, the more impact it essentially has. So kind of like a very recent event that would happen, say 1 second ago, it'll have a huge impact on the financial markets or on your mind, versus an event that would happen 1 week ago, versus an event that would happen a month ago. And well, that's just how life works. So the whole idea is to use something called a time-aware LSTM. And it simply means that in the sequence, you also feed in timestamp information. That's all it means. I won't get into the math here. It's a bunch of those boring equations, which I think everyone has seen. All it does is it says, when you calculate the current state of this LSTM, don't just look at the historical state, weigh that or multiply that by a factor which is proportionate to how far away that is from your current timestamp. Pretty much that. Once you do that, the main block of this diagram is explained. You encode everything through BERT. You feed it through a time-aware LSTM. You put it through some kind of attention mechanism, kind of like the attention BERT puts on words. Similarly, you put attention on this sequence. And once you have that, you now have, again, a time series, which is what you see on the right. I don't know if I can. Yeah, this right here. This is basically the new and modified stock features. This is what the neural network ended up learning. And well, now if you put this through any kind of dense neural network, anything really, a feed-forward neural network, you can pretty much predict if the stock's prices will go up or down, or if you want to rank them or anything. So a little bit more on what the novel part of this paper was, and pretty much where, and I think once we realized this, we thought, what is the harm in trying this for a user modeling problem? I keep saying it's very similar to user modeling. So let me also elaborate. The first idea after this got accepted was, why don't we try this exactly the same architecture? No difference. If you open the paper, you'll see it's pretty much the same architecture. And we thought, what if we apply this to a user modeling problem in a very different way? So the work was different in a way, but the same architecture. How is it going to do? Turns out it ends up beating all the SOTA models for fake news, mental health moderation, everything, without even too much parameter tuning. I think it took 2 days to run this on 4 different data sets in 2 different languages. And that's kind of how we ended up getting, well, a very quick EMNLP paper in a way. So the reason I mention all of this is, and this slide specifically, is because this is the novel contribution here, that news, tweets, well, practically everything have dynamic time irregularities. Everything in the world has, right? Like even, well, the schedule today, right? We started a little late. So everything comes with dynamic time irregularities, and we need to factor that in. By definition, LSTMs, RNNs, BERT, these are modeled not for sequences, although we might think they are, but they're rather modeled for, say, sentence modeling or words or anything. And factoring in the time for irregular time series, which is how most time series are in the real world or in the industry, is important. Now, talking a little bit about the actual money. So every millisecond that we don't factor in, this is from a production result, and well, this is also from Wikipedia. So obviously it's true since I copied it from Wikipedia. But every millisecond that you lose time in the stock market, you lose about 100 million in a year. This is every millisecond. It's not a second year. Now, within a day, this time-aware LSTM can factor in what is the impact of these time irregularities, and then successfully, more accurately predict if the stock's price is going to go up or down. The reason we have this hierarchical is you can break time as you want, right? For stock markets, you can do it within a day and across a day, across a week. So if you do something like user modeling, you could say, I'm interested in knowing 2 things about a user. Or maybe something like, if I was to ask you, what was your favorite day of NLDB? You might say today to make me happy, but obviously it was yesterday because of the food. So that's more of an intraday thing, right? That's more of a characteristic of a specific day. But years later, if someone asks you, how was NLDB 2022? You'll hopefully say that was very nice. And that's kind of where a hierarchical time modeling also comes into the picture. This is a little bit of math, and I don't like a lot of math, at least when I'm presenting, but I feel this optimization is slightly important. This is how we change. What you see on the left is very common. It's a regression loss. What it means is we're trying to accurately predict what the price of the stock is going to be. So if the price of the stock right now is 10, and if my model predicts it to be 11 versus 12, the regression loss pretty much factors in the gap. I think everyone knows this here. What's more interesting is on the right. I'm not going to explain the math behind this, but this is the component you need to add to any neural network, anything with user modeling, whatever, to start adding it to rank. That's pretty much all that happens here. Not too much on this slide. Now, a little bit on how we evaluated this in the real world, in the industry. So we tried this on 2 different data sets, 4 different markets. Data sets were in English and Chinese. The reason we chose English and Chinese is those are some of the bigger stock markets that deal with news-related information that react very quickly. So like a tweet from Trump is going to make someone millions and billions. That's how it works. So we tried this for some historic data, simulation data from 2014, 2015, that range. You'll see more data sets later, which also cover the COVID time period. We do this for NASDAQ in the US, and these are mostly China-oriented Chinese markets. The strategy is fairly straightforward. When I say strategy, it means the actual algorithm that automatically buys and sells stocks to make money. That algorithm basically says that if the stock's price is going to increase, buy the stock. If the stock's price is going to decrease, don't buy the stock. That's pretty easy. If you buy the stock and the stock's price is continuously seeming like it's going to increase, keep the stock, don't sell it. If it seems like the price will go down, sell it right now to make whatever money you can. That's basically what the algorithm does. The returns or the way to evaluate such a model, Sharpe ratio it's a financial term which says that the higher the Sharpe ratio, the more money you make. Now, I'll help you understand what it means with examples when we see the results, which are here. So say something like, look at the SR column in both of these data sets first, and look at the ones at the extreme bottom. So the R, LSTM, rank, net, fast. These are the ones that we have, which do ranking using, say, NLP related stuff. The table that says components, everything that says T over there has text or natural language data. Everything that has P has price related information, and well, everything else is, you can read it in the caption. But the idea here is that if you look at the oldest model, so AZ FinText or WLSTM basically means a word LSTM, the normal LSTM we all use. So the Sharpe ratio there is 0.41. And for our model fast, it's 0.96. What that means in real terms is that if you invested 1 million, a regular LSTM would lose you about 100,000. And our model actually did make us about 3 million, so about thrice the money back. Again, the code is online, you can try it, but with your own money, obviously. So the takeaways from this slide is, first, any kind of ranking formulation in general, not just for stock trading, does better than classification or regression. That's quite obvious because classification only says predict yes or no, whereas ranking takes it one level further. The different modeling paradigms are on the extreme left column. So you'll see regression, classification, reinforcement learning, then ranking. Then we also see that, and this is actually a very big revolution in the stock industry specifically. So when we did user modeling or social media analysis, everyone always looks at text. But in the financial industry, until say 2015, no one looked at textual data, not at all, zero. They only look at price related data. They see if the stock's price has been going up for the last 10 years, it's likely going to increase again. They don't factor in things like someday Elon Musk will wake up and put a crazy tweet and everyone loses a bunch of money. So, or well, now everyone posts, right? So essentially the idea is that textual sources can capture a lot of different market related information. And when you factor in natural language to finance, you end up making more money. The final takeaway here is that it ends up consistently doing well across these different stock markets. So it's more of an evaluation thing here. I won't dive into each of the baselines, but in a nutshell, these are all past. These are everything we could find from ACL, NACL, EMNLP, all the NLP conferences in the last 5 years. So the more interesting thing, I think, is an ablation of why we have such a complicated model, seemingly complicated. So if you look at the first row, the SLSTM, it's basically what is a standard LSTM, a single LSTM. If you just feed your text time series for any task there, that's the result you'll get. Again, these are all financial metrics, but the upward arrow means that the higher the metric, the better it is. So if you start comparing it with the variants that have attention, you'll see that it brings more value. You'll also see that anything which has, which is hierarchically modeled, which I mentioned, where if you first look at things within a day, then across days, it does better than just feeding it directly into a time series. Some more quick results here. An interesting analysis here is an analysis on the look back window. It says how much historical data do you need? So in the financial industry, we don't want, ideally, if we use all the data available, we'll be the most informed to make the best possible decision, right? Kind of like with user modeling or fake news also. The more data I feed into a neural network, the better it should do because it has more information. But in the financial world, we can't just say take all the data. And why can't we? Because the more data you pump in, the more it takes these models to infer and train and everything, and we need to react very quickly. So we did an analysis to see this look back window analysis here to see what if I start feeding it more and more data. So the capital letter T here represents the amount of days of information we feed it. And interestingly, you'll see after a point, if you start feeding in more and more information, the performance starts saturating or even decreasing. So our takeaway here for sequential models is not always does all the information make more sense. Rather, at times, it's also cost effective, faster, and better performance to not feed all the data, but just the more recent data. Quick conclusion on what we learned out of this before we move to the next part is whenever you're doing sequence modeling, if it's anything NLP related, if it's not NLP related, if you have timestamps, if you can find timestamps from anywhere, use them. The worst that will happen is your timestamps will be equally spaced in time and your model degenerates to a regular LSTM. But in 99.9% cases in the real world, that's not going to happen. So it always makes sense to think of time-aware LSTMs, time-aware transformers, all of that. Hierarchically modeling your time series also helps. And the last is ranking is always great in terms of, as a step forward in terms of classification and regression-based methods. So that's a brief gist of how we started this with NLP. I'll take a minute to drink water and then move on to the next bit. But if you have questions now, you can ask me instead of then. Yes.
Very interesting architecture. I was just wondering, take a Predictive, for example, say a tweet comes out from Elon Musk, X, Y, Z, or NBC, how do you assess whether that's going to be and goes down? But do you not look at the actual content? You just look at the timing.
No. We look at the actual content as well. So the moment, so there's a stream of tweets that we keep listening to. The moment the tweet comes in, there's something like a distilled encoder, which will quickly encode it to a reduced dimension similar to BERT. And that encoding then gets fed into this model, which has already been pre-trained on, well, billions of tweets. And once it goes there, it infers if this tweet is likely to sway the market. And if yes, then by how much? So it actually takes the textual content as well. That's where this text embedding layer comes in. So we feed a sequence of embeddings.
So is it a kind of sentiment analysis, or is it strictly looking at the word vector, say, oh, Elon Musk said something like this before, or?
No. So there's basically a variant of BERT, which is called FinBERT, which is basically being trained for financial sentiment analysis on, I think, 6-7 years of data. It's a pretty common model that we use in the financial world. That pre-trained model is then fine-tuned on this specific task. So it's not just generic BERT, but it's a fine-tuned transformer model that encodes these.
But this FinBERT looks at the actual contents of messages.
Yes.
Thank you very much.
Yes.
How do you decide how much money you invest in this decision? I mean, for example, if Elon posts something, do you calculate something like, oh, it's of big importance, so I'm going to buy quite a lot of stocks, or how does this work?
I think that's a great question. And that's kind of where this metric called Sharpe ratio comes into play. So it's a metric which says, I mean, if I just look at profit, if I just say that one strategy made 1 million and one strategy made 2 million, and if I say that strategy 2 is better because it made 2 million, that's not a correct way of evaluating. But I also need to see at that point, what was the risk that I was taking to potentially lose that 2 million. So whenever we get a tweet, we look at it calculates a Sharpe ratio and it ranks the stocks with something like a risk metric. So the risk metric essentially says, if you were to invest 1 million, there is a high probability that you will lose X amount of money. And then there are hard-coded, so we have to do this in the industry, the hard-coded risk checks, which say that if you already have lost some money today, you can't invest more than X. So in a nutshell, the neural network predicts risk as well, which is that volatility number I showed in the beginning. If it's a lot of volatility and you have risk checks in place, the model will prevent you from, say, going crazy and putting a lot of money. And an example of this is, it's a pretty common article. I'm forgetting the name of that company now. In fact, I don't know how many of you know what happened with GameStop, etc. last year in COVID. Some stuff happened with it, right? I won't explain to those who don't know. It's a big company in the US, which a bunch of people on Reddit decided to start posting and saying, we're going to take down the big corporations. Somehow it worked, and these big corporations lost billions of dollars. And a bunch of these companies don't have any risk checks. So in fact, there's, I think, Knight Capital or something. If you Google this, you'll find this name. It was a very big company that used to deal in trillions. And they had a neural network strategy that wouldn't have no risk checks. So it basically say that if there's a chance of putting in 1 billion and making 10 billion, it will do it without looking at anything else. And one day that strategy, it read something wrong. Obviously a neural network can be random, predicted something wrong. It invested 100 billion or something, and it lost everything in a shot. So effectively you need to have risk checks in place. And that's kind of where the volatility part comes into play.
Yeah, thank you for that first part. So you make it sound, because the timings are so short, that the system itself has the trigger button, let's say.
Yes.
Yeah, because you don't have time to double check whether
Yes.
the assessment is right. So is the next step here worrying about adversarial systems that know your architecture and know that if they post very quickly a bunch of references to stocks and negative sentiment, that they could trick your system into making money off you, I guess, in that way?
In a way, yes. And that's what the third part of this is going to be. It's exactly that. But to add an interesting point here, when we talk about latency, it's not even, I'll tell you some rules which are kind of unsaid rules in the industry, but that are there. The first thing, and you might be really surprised to hear this, is the algorithms don't allow division, the division operator, the inverse of multiplication. The reason I'm saying this because it's a pretty shocking thing. Algorithms in the industry for financial stock trading at this frequency, you can't do any division at all. Exponent is a very big deal. You can't even do a division. These don't run on servers. If someone knows what is an FPGA, anybody knows what an FPGA is? No? FPGA. You should potentially Google it, but it's called Field Programmable Gate Array. Everyone knows what a transistor is or a chip, like a motherboard that goes in your computer. It's a tiny chip that doesn't do too much. It can't do too much. It can maybe have one or two if-else conditions. That's it. That's what actually triggers the order here. It's not a computer code. There's no loop. There's no division. The model trains. It brings out a bunch of inference rules. Someone in the company will write that in assembly language, not even C++, in assembly language, and hard code that onto a chip. When I say hard code that onto a chip, someone's going to sit with an actual wire with fire on it, burn it onto a chip, and that chip memorizes what it needs to do. And that's how that chip trades this at nanoseconds of latency.
Yeah, I had a question related to that. So what is like the latency goal? Because I guess you first need to scrape the tweet, right? So you lose some time there, then you run BERT, and then you run the LSTM. So I guess there's at least like 200 milliseconds latency, which seems like is a lot.
Right.
In this use case.
There are two answers to that question. The first is there's a different domain of trading called more mid-frequency trading, which is more minutes or say hours, which is what more common people do. So as an individual, I can't go and trade at nanoseconds anyway, which is kind of why if I just go and start putting in random trades in the market, I'll lose money. It's kind of like when you go to gamble at the casino, the house always wins. It's like that because you don't have that equipment. But rather as a human, what you can do, or with a mid-frequency strategy, is you put in money and you say, I won't touch it for the next few hours and I'll then trade. And that won't make you as much money as it would if you do it very quickly, but it's the risk-reward trade-off. The second aspect here is that you won't just look at a single tweet. That also talks a little bit about that adversarial thing that we spoke about. If you just look at a single tweet, it's very easy to influence everything. Rather, you look at a bucket of tweets that come in, say, 5 minutes. If you look at any big stock like Apple, Google, if you go on Twitter right now, every stock on Twitter is prefixed with a dollar sign. So if you go on Twitter right now and search for dollar Bitcoin or something, dollar BTC, you might find more than 1,000 tweets in the last 2 minutes, more than that for sure. So we take in per every 5 minutes a window of that. And that's where the attention model comes into play. And that's also why it's hierarchical to kind of do this in a nested structure. Okay, we continue.
Questions? No?
Okay. So the next part, this might be more, I don't know what the correct word is, but more mathematical in a way, but we'll try to not get into the math too much. But again, this is similar. This is also something I learned from user modeling. So the same EMNLP, we had this previous paper I showed you. We had a paper on user modeling where we tried something with graphs. The whole idea there was that as users, if you want to do any kind of, let's say, fake news prediction, mental health moderation, you see that these people don't work in isolation. Rather, they work in groups or they're influenced by each other in some way. So a takeaway here was that stocks are also influenced by each other. And we can skip this. We spoke about this already. So let's talk a little bit about patterns in stock price movement. So when COVID happened, pretty much the airline industry died, right? Like I think it did. Tourism, travel, it all completely stopped. And what you can see here, the stocks in red, you'll see that they pretty much collectively showed a very similar pattern. They all collectively kind of just dropped around April 2020, which is when, I think all travel stopped completely. I think around June, it started picking up a little bit more. If I had more of this graph, I think you'd be able to guess how it looked like. The computer tech software space kind of dipped and then it rose back again. And if you look at just pharmaceutical or healthcare stuff, you can see it pretty much just increased naturally, right? Mass production, vaccines, that kind of stuff. So an interesting thing to learn here is that, and that also helps with latency, is instead of looking at every single stock in isolation, kind of like when I look at users for fake news or anything, don't just look at people or stocks in isolation, look at them as groups of things that influence each other. Now, the most common data structure that you would think here would be a graph. So what is a graph? I mean, imagine every single user or stock as a node, and two nodes are connected if they have some relation with each other. A good example of that is Elon Musk owns the company Tesla, and he also owns the company PayPal, for those who don't know. Now, an example is if for the company Tesla, he says that the Tesla stock price was too high. I don't think I have an example here, but that tweet we saw earlier, the moment he said that, the Tesla stock price going down makes sense, but the PayPal stock price also went down drastically for something that had nothing to do with PayPal altogether. So the stocks, like users, get influenced by each other very easily. The difference or the novel thing here is, and I think this is something we do not very well in social media modeling also, is we think of everything as a graph. And when I say a graph, I mean a regular graph. And what is a regular graph? A regular graph is something like this one here, where you have a bunch of nodes and every pair of nodes has to be connected by an edge. But what's stopping us from defining a graph where, say, there are 3 nodes and all 3 vertices or nodes are connected by one edge? And why do we need to do this? If I want to model something like the COVID impact, the collective impact on all the stocks related to the travel industry because of COVID, I could either model everything pairwise. So if I have n stocks, this would be NC2, about n square, order of n square. So if I have 10 stocks, this would be about 50, 100, something like that. If you start scaling this to financial markets, if I have 1 million stocks, I'm going to 10 million. Instead, if I say that model every single stock in the same industry with one edge, just one edge. So here I'm changing the definition of a graph from, say, having an edge between 2 nodes to an edge can have any number of nodes. And when we were researching this, we realized that this is not very novel in the mathematical or modeling world. This is rather something, it's an ancient thing called a hypergraph. And the regular graph that we use, the graph that we just use for every algorithm, is, well, a very special case of that graph, which says that every edge must only connect 2 nodes. Whereas in a hypergraph, you can connect as many nodes as you like, and every hyper edge, the word is hyper edge, can have different number of nodes in it. So this here is an example of a hypergraph. So you will see that we can have one hyper edge which says that these stocks, Synopsys, Adobe, Autodesk, these are all computer software industry related. These are all transportation related. These are all pharmaceutical related. And essentially, now you can also draw a parallel here with users. So you say every node is a user and every hyper edge is a collective relation between them. For example, let's talk about NLDB tweets again, right? Every user here has collectively attended NLDB. So a better way of modeling all of us is putting us all together in an edge that we all attended NLDB. And then everyone else could have their own different set of relations as well. So what we changed here from the work you saw before, in the previous work, we looked at every single stock as an individual item, where we fed it a time series of, well, all the stock related information only about itself, only the tweets or the social media data about itself. What we change here is that we now have a hypergraph which connects all of these different stocks and then feeds into that time series related information. So let's talk a little bit more about what these different influence movements look like. So if you look at this graph here, it might be difficult to see on that screen. It's a little, I guess it's a little far, I don't know. But what you will end up seeing is that these stocks influence each other in many ways. For example, if there's a certain company, so let me see what is an easy example. These are all Chinese companies, so maybe not the most relevant, but there are certain Chinese companies here that own a different subsidiary, kind of like Coca-Cola owning, I think it owns Sprite, for example. So if the Coca-Cola sales drop, or if someone says Coca-Cola has a pesticide, very strong chance you won't also have Sprite, right? Or, well, if someone says the food at NLDB one day was bad, right? Very likely you will think that it's going to be bad the next day also. So that's kind of why we model these different stocks as graphs. And it's a proven theory in finance and in social media, psycholinguistics, that user graph, stock graphs, these have these things called scale-free patterns, which means that they look more like trees and they influence each other in many ways. So here's yet another complicated looking architecture, which in a way is also very simple. On the left part is what we had already, what you saw in the first part, where you have different stocks with their time series information. You pass those through a feature extraction method. So this could be like the word embeddings, BERT, whatever you want to use. You get the embeddings across time series embeddings. Now what changes here is instead of directly feeding this into a model, I'm going to initialize my node features. So every graph has nodes, and for every node, you can initialize it with any set of features. So I initialize it with these set of features. I do something known as a graph convolution, which means for every node, if I'm at the Apple node right now and I'm training for the node Apple, I look at all the neighboring nodes. Neighboring nodes means the nodes that influence Apple. So maybe Samsung could be one because it's a competitor. And I also enrich my training and embedding process with all the neighbors. This way, if anything happens in PayPal, Tesla directly gets an impact and vice versa. The end problem statement is very similar. You treat it as a node classification problem. So predict if the price will go up, down, or you rank or well, do anything there. This is the fancy looking math behind it. It looks fancy and complicated here, but it's not. It's just a bunch of stupid matrix multiplications. We won't go into it in depth, but what it basically does is it says that if I have a node, let's say I'm talking about this blue node in the middle, it sees what are all the edges here, and it will do some kind of an aggregation. You can think of it as a weighted average, a learnable weighted average from all the neighboring nodes. That's all it does. Then once you have these, and since the stock market is temporal in nature, the graph is going to change over time, right? Companies will lose relations, etc. Kind of like on Twitter or Facebook or well, whatever it is that people use nowadays. The friendships change, right? Or patterns change. So these graphs change over time. And essentially the embeddings you get, you then feed these to a sequential model. So all we did from the previous paper was we added a graph, a hypergraph to be specific. And in that hypergraph, we added some graph convolutions, and that's it. An interesting point here is because you now have a graph, right? You can also parallelize your training. So this is more like an industry optimization step that you train every node in isolation on, say, a parallel GPU. Obviously, the industry has very expensive, fancy hardware. So this training can happen really quick. We'll skip this. This is just, my mind hurts when I look at this, but this is like the core architecture of what these convolutions look like. This is just basically the classification. So that's the equations in the previous step go through a softmax and it does the classification, the basic stuff. The data here looks at some pre-COVID related stuff, and the final part will look at the post-COVID related data. So here, this is another way we do training and evaluation in the industry. We take a huge amount of data, which is about, I think this is 6-7 years of data here. We break it into different phases, which we think are different phases of stock activity. So if you look at something like phase 6, phase 7, these are, or even phase 8, these are periods of strong economic growth, of tech growth, where if you just said, let me put my money in any tech stock, and you sit down on it for say 3 years, you don't do anything, your money will double or triple. That's it, as simple as that. We then look at phases of recession like 2018, even parts of 2019, where the prices drop. The reason we have different phases is just for more varied evaluation in a way. Now, this is how the evaluation of the strategy works. What you're seeing in gray and yellow are two different stocks. And essentially you, at this point number 1 in the graph, we decided that let's buy both the stocks. The algorithm triggered something and it said buy both of the stocks. And effectively now the algorithm needs to decide on the gray and the yellow curve, when should it sell the stock? That's the idea. So now if you look at point number 11, if it sold both stocks over here, it would make money. For the yellow one, you see it went from about 100 to 120 for a single stock. So if you invested something like $1 million, you would end up with 1.2 million in 11 days. But then similarly, if you waited just one more day, you would pretty much lose all of that money. You would pretty much, instead of getting 1.2, you would reach something like 70 million. That's kind of why it becomes important to predict everything very quickly as well. Now, this is pretty much the same trading strategy we saw. So let's talk a little bit more about the ablation study here. We don't need to look at it in a lot of depth, but the point I'm trying to portray here is that the first line is the initial model that we had for that you saw in the first part of this presentation, which only looks at temporal information. And if you look at the last row, you'll see that's the one that includes the hypergraph. That's the main idea of this slide. So essentially, modeling things as graphs drastically improves your temporal models as well. We'll skip this. Now, let's talk a little bit about how important are each of these stocks. So this might look complicated here, but the top of this graph, the purple or the green lines, represent if I model everything as a hypergraph. And the bottom, which is where the performance drops drastically, is if I just degenerate that hypergraph into a regular graph. So effectively, if I take every single hyper edge and break it into corresponding NC2 edges, this is what it brings. Takeaway here is that the hypergraph modeling really helps, and you should effectively think of, whenever you're modeling a graph the next time, think if it needs to specifically be a graph or can it be done as a hypergraph. This is again the same money related comparison. You'll see that compared to more traditional models, so LSTM here is a very old regular LSTM model. It's, I think, one of the first neural networks of financial trading. If you compare the performance for, say, NYSE, which is New York Stock Exchange, it's about a 10 times multiplier in terms of the profit comparisons. Again, I won't go through the depth of this table, but the whole idea is you make a lot of money if you model it through graphs. Same analysis here with graphs also. More data doesn't always help. You should always be mindful in terms of the amount of data you use. And very quickly concluding this, our summarization is that with a large amount of data, it's very likely that stocks, users, fake news, weather, everything impacts or influences each other, which means that you don't necessarily need to model everything individually. You can also model things as graphs. In fact, everyone has started doing that. I think from 2019, if you look at the user modeling track in any top NLP conference, you'll find the graph, hyperbolic graph, hypergraph papers everywhere. And then we see that this does better than just classification, regression, reinforcement learning type of stuff. And before we move to the next part, which I think will be the most interesting for the group here, we'll talk a little bit more about how this gets multimodal and what are the ethical bias related implications there. Yeah. Any questions before we move ahead?
Yes, thank you. Very interesting for me also because I work with graphs. So I have a couple of questions about that. Maybe I missed it, but the graphs and the relationship between the stocks were learned automatically from correlations in the stock market?
Yes and no. Yes, because they are learned dynamically. So when you're training, you can change the weight of the edges. So let's say it's obvious, right? At some point, these stocks were not relevant. After a point of time, their prices became correlated, say because of something like COVID, and then it changed.
Yeah.
So you initialize with whatever static metadata you can find, which is something like creating a knowledge graph out of Wikipedia. You say that Elon Musk has both Twitter and PayPal or whatever. Sorry, Twitter now, but Tesla or whatever. And then you say that while you're training, you dynamically add or subtract edges based on what the training looks like.
And if Elon Musk is driven off by his board of directors, someone manually checks and updates the graph with the information?
Not manually, but there is a script that, so think of it as a two-phase training manner. Every week, the initialization of the graph changes and we retrain with all the price related information. That's kind of where this slide comes into the picture, where we realize that 8 days is a good amount of time period. This is 8 days, including weekends, because we trade crypto on weekends also. So essentially 1 week is sufficient. After 1 week, you throw all the stale data, you reinitialize your graph with the code automatically, and then you start training from scratch again.
Okay, thanks.
Cool. Okay, I think we continue. Okay, so the last part here, this is probably what's going to be the most interesting to the audience here. There's another thing called earning calls, and these earning calls happen for all these big public companies. Rather, it's a mandate. They need to do these earning calls. And what happens in these earning calls is a big person like a CEO, board of directors, someone like that, comes to a meeting room like this. It's full of media representatives and big people. They come and they give a speech and they say something like, in the last 3 months, we made this money. These are our new products, or Twitter is getting acquired by this company, or kind of like, at the end of this conference, Paolo probably will come and say something like NLDB had, these were the highlights, and this is where, what the future of NLDB is, something like that, like a summary conversation. So all the big companies need to do this from a government perspective. And pretty much 92% companies that trade in the world, which have stocks, they have these earning calls. Now, these earning calls are different from our regular stock or Twitter related stuff. They are bigger things. So if you look at this graph, this is an earning calls for Facebook. On the left, you see what the price was like across the day. You can see their earning call happened around 4 p.m. and then the stock just vanished. Vanished means 150 billion lost in 3 hours for Facebook. And they said a bunch of stuff in that earning call and people weren't happy with it. And that's kind of how this happened. So what now, and the reason why we're interested in earning calls is they lead to very large movements in stock prices, huge. So it's a very big money-making opportunity. And if you look at, this is basically the earning calls for Google. This is basically how much the Google price changed during the earning calls. The yellow peaks are all when the earning calls happen. So you basically see that these are the biggest times when a stock market moves. And when these earning calls happen, all the employees are glued to their computer to see how much money we're going to make or lose. An interesting thing about earning calls, which is where it gets different from tweets, is an earning call session is kind of like this, what's happening right now. So there's a lot of scope to not only see what the text is, but also listen to the audio that happens. Imagine you ask me a question right now on how my company is going to perform. And I very confidently say it's going great. In the second option, you see me crying and you see me hesitating and you see me something like, it's going great, but you can see the tears falling out of my eyes. At this point, if you just look at the text information, you've missed out on the entire context. Now, let me contextualize this in a more serious thing. There was an earning calls, there's a company, I'm forgetting the name now, who had something like an eye drop solution or something, and they said it's going to be revolutionary. They gave the eye drops to some kind of clinical trial in a homeless community or something like that. And in their earning calls, they were asked a question that how hopeful are you and this is actually why this example is why people started looking at the audio. The person actually, I think someone else in the background started crying when this question was asked. The person had complete hesitation in their voice, but they confidently said that we are hopeful that this product will work. 10 days later, a news comes out that a bunch of people have gone permanently blind. This is real news, by the way. And the product was a complete shit show. So there was one model at that time in the industry, well, in academia also. So these papers started surfacing around 2019. It's very recent. That correctly predicted and said that this company who had a fantastic earning call will fail. And they bet, I think, about 100 million on this eye drop company to fail. And I think they got all the money from everyone else, like billions, just by catching the tone of the voice. It's similar, right? Like for even user modeling or everything, from doing mental health prediction, anything. One thing is looking at the notes. One thing is listening to the person live. So this is what the schematic of this looks like. This is a much simpler diagram. What you see on the right is just that trading, buying, selling. Don't look at that. What you see on the left now is we don't just look at the text transcripts. We also look at the audio related information. So now you need to have a multimodal encoder here. You predict the volatility, which is the risk, the price increase or decrease, and you buy and sell a stock. Simple. Looks again like a complicated architecture, but very straightforward. For the text, you encode it through, in this case, we used GLOVE. We used GLOVE because BERT was very new then, but you can use BERT. For audio, you just pick up features that you think would capture things like hesitation, etc. So think that, jitter, harmonicity, the loudness of the voice, these all correlate to the confidence, hesitation, etc. So you add some psycholinguistics here to see what audio features make sense. You again feed those through similar LSTMs, you do a multimodal fusion and you classify. Pretty straightforward stuff. Very quickly, the impact that the performance here has, the blue thing on the extreme left is if I just have financial metrics. So the baselines that we use in the industry today. And the last blue line is the performance if you have the multimodality included. So more than double, which you would think it doesn't make a lot of sense to have so much of voice data, but it really has a huge impact on profit. The person who introduced this made a lot of money. So I wish I did, but I didn't. I just published a paper and got no money. This is more of the time analysis, so we won't bore you with this. This is what the profit simulation looks like. So this might be interesting for you here. On the left, the profit column here, this is what happens if you invest $1 US in this voice trading strategy for one stock and you hold it for say 1 week. So if I blindly say without thinking at all, just buy it, everything, I'll make $36. I'll still make some money out of it. If I randomly choose, make a random decision, which is what most people do, you lose $50. If you now use the text only model, you will make $60. But if you use the voice model, you will make $75. Now this is on $1. If you scale this to 1 million, you will understand how much money that is. The only interesting thing, which is what I'll quickly show now, is when you add voice, right? And this actually came to me in a rebuttal. So I learned this in a conference. I never thought of it myself. When you're looking at text, it's easy. The moment you add voice and you start training on voice-based neural networks, you add in bias. And what kind of bias is this? This is gender bias, this is ethnic bias, this is demographic bias, age bias, everything. The person who gives most of these talks is an American man in his mid-30s to mid-40s with a more manly voice, I guess. And what that means is that these models end up learning something like, that if the voice is more shrill, it's more low-pitched, perhaps. I'm not saying this, but I've seen this in ethical studies, that if the voice sounds more like a female, this company is bound to doom. That's what these models end up learning adversarially. Why do they end up learning this? Is because the more common models that they've seen are, well, the financial industry or the world in general has been so skewed in an power imbalance. To give us statistic here, of all of these publicly traded big companies, the female representation, female, trans, non-binary, basically non-male representation is below 3% in the boards. If you now look at the specific ethnicity, demographic, or age, it becomes like 1%. 1% majority has, what these networks learn. And if anything breaks the norm, these neural networks immediately predict that, oh, it's a woman speaking, so this company is going to fail. This is what happens in production today in the financial industry. And it's not just these models, it's a bigger problem in the industry as a whole. If you go to Wall Street, there is no female representation. There is a very specific demographic of people who do this kind of work. So this is what we presented in NACL last year. First, and this should be very obvious, why are we studying bias? I don't need to show this, but basically there can be bias in AI in the financial industry. And this is not just understudied, it's not even known, right? Like if you go to any financial company and you ask them, does something like this exist? They'll probably scratch their head and say, maybe it does, but what do we care as long as it makes us money? The problem is that the reason why companies get interested in this is because they lose money when they gamble incorrectly, right? I mean, if you look at the company Bumble, it was very successful and had a great IPO. It made a lot of money for the people who bet correctly on it. But every single model said that it's going to fail because, well, it was a woman who was associated with it. You already know this. What we're going to do here is quantify the bias. So this is pretty much the same stuff. So what we're doing here is we're kind of looking at how error prone are these models across genders. So this table, which has delta G, it basically says that there is a bias of about 0.38. That means a model is about 50% more likely to say that a man will succeed if he says exactly the same things that a woman would say, with no difference, just the audio, the speech of the gender difference there. So essentially the goal of this study, and that's why it's an open problem. So I feel if people are interested, they should look into this, is there is a huge bias. How do you solve this bias is an open problem. We don't know how do you train such a model without adding in such kind of bias. The sources, as you can see, these are, if someone is interested, on the right, you'll basically see all these different features. The ones with the most arrows and the stars are basically the ones where you see what contributes the most towards these biases. And it's interesting to see that the number of times someone stops talking, like now, even for a second, like a pause, it factors that as a lack of confidence in these models. If I have a lower volume in my voice, if I'm coughing, if I'm older, if I don't have a British accent, it'll assume that I'm bound to fail in a way. So what that leads to is that there are a bunch of ethical considerations here. The good thing is this data is all publicly available. It's mandated by the government to have. There are a bunch of biases. We've only looked at the gender bias so far. We looked at gender bias only because this is all public information, so we can get access to publicly self-reported gender. The goal is to not predict gender from name and all those ethnically questionable things. And the last thing is that it's not just a neural network problem, but it's a problem in the world as a whole. The reason why the neural network does bad is because, well, there are not too many female examples to learn from anyway. And why are there not enough female examples? Well, that's a general problem. If I look at this room right now, I think that answers the question already. So in conclusion, we basically analyze gender bias across these different problems. We learned that in all of what we studied today, if you add text to your financial models or you add time irregularities to any NLP models, they do better. You add a graph onto these, they do even better. They make tons of money, and they actually make tons of money in the real world. But when the big time comes and they need to analyze things like when you need to start looking at the voice, they do that and they lose a whole bunch of money because they make stupid conclusions based on bias. And yeah, I mean, the future work for me is pretty much looking at how to debias these kind of models. And the reason why people are interested in the industry is because debiasing also has a profitability impact. So yeah, that's an open question for all of you to think about. And that's it. Thanks a bunch. Okay, any questions? Yes.
Thank you for the talk. It was very interesting. I was just wondering, I think your company is not the only one doing those analysis. And I think, as you said, if you put more money in it, there is also more to gain from it. But this raises the question for me, how much of the market is basically just influenced by those models and not by the trading anymore? So isn't it like a demographic or a democratic approach or a democratic decision of all those models from all those investing companies that the stock will go up and therefore the stock will go up?
Yes and no in a way. I think what broadly happens is that because it's a latency game, latency meaning speed game, essentially when an opportunity comes in the market to buy something, you have it for about 1 second at max. So everyone wants to predict the same thing. Everyone wants the same model. And then the one who can predict it the quickest will end up getting the money. It's kind of like saying, there's one toffee lying on the floor and there are 10 people with the same, they all want that toffee and they're all going to jump towards it. And the one who gets it the quickest wins it. So pretty much everyone runs the similar kind of models because it's all publicly available data anyway, right? So that's...
I'm not sure I understood this right, but I think you had a table there where you said investing $1, you get $36 in a week. Can you explain exactly how this works?
So, okay. Okay, so what you're seeing here is this is 24th October of 2020, I think that's when this paper was published. So we start on this date and these are 3 stocks here. So these stocks, these are the names of these stocks. BKNG, you people might know this. This is Burger King. I think people would know this. So yeah, this curve here, Burger King CS3. If on this day I decided to put $1 in Burger King and I had this predictive model, it would tell me that just sell Burger King on, what is this, after a week on 6th November, after 10th October, or 24th October, I would say sell this. If you would sell this at that time, the 1 would become 36. So basically what I'm saying is don't eat a burger from Burger King, rather invest the money here and eat more burgers later.
Very nice talk. I really enjoy it. I have one question. So you mentioned Bitcoin before. So how well works this in such kind of a market, which is that wild and whisper driven, let's say?
Right. No, I think that's a great question. And I should have included those slides. In fact, the cryptocurrency version of this is now on archive with Paolo. He's an author in that paper. So cryptocurrency with NLP is, we'll have it in NACL. So the paper describes most of it. The short answer to it is that you need to just be quicker in terms of how you react, right? And when I say you have to be quicker, I mentioned that field programmable gate array, right? That chip that you burn stuff on. Apparently, that's also too slow for cryptocurrency. So they're now looking at not even having a chip. We essentially buy space near a crypto exchange, and we connect a direct wire to the trading exchange, to the exchange itself. So you pay a lot of money to get that, which is what big companies do. And at the wire, there's a switch, and that switch just presses yes or no, and the trading happens. So basically, you need to either wait till hardware gets more sophisticated, which it is with GPUs and TPUs and everything. And in the meantime, you just need to be better with your hardware. I mean, the problem statement is the same. You still have tons of natural language data. You feed it through embeddings, LSTMs, graphs, whatever, and everyone's doing that. Then you just need to be really quick. So for that, you need to be as quick as possible to the exchange. I'll give you an example. If I sit here and place an order in the stock exchange, it might take like maybe 1 second to send my data from here to transmit the packets over Wi-Fi or whatever. That 1 second is too late. By the time I'll send my order, someone will have already bought it. Why that happens is someone has already paid the exchange. They can do that to keep their machine right inside the exchange. So the order goes immediately via wire.
Yeah, thanks again. So this might be a little bit of a zooming out of the whole talk, which I don't know if it's very suitable. But so every prediction made here is based on T or T minus 1 or like the previous value of the stock and whatever happened since then. But obviously, at some point there's a real world value of a company. Let's say their inventory or something. Sure. And now we're basing all decisions on whatever other people are going to do with this stock, probably making money over them where they are slow or they are wrong.
Right.
What do you think about this other way of looking at stocks, that the company at one time has to be some value and not just a prediction of value? Let's say.
Right. I think that is kind of a financial philosophical question of sorts. But if you look at something like Bitcoin, right, what does it even mean? Or if you look at something like Dogecoin, like the coin with the funny dog on it, right? It means nothing, but it's still there in billions. So that's one thing that there's a principle called efficient market hypothesis, which says that the price of the stock based on other people's opinion always captures all the information. So what it means is, for example, if you invest in a stock, maybe you invest because others said so, but there is a good probability that there must be at least one person in that list who knows what the actual value of that company is, whether it's inventory or whatever it is. So let's say, so that's where these earning calls happen. When an earning call happens, the company says, we made this much profit. I have this much stock of iPhones worth right now. This is what Apple will say in their earning call. Now, based on that, you react to that particular market. So a stock has something called a face value, which is what you're saying, the value, inherent value of it. Unfortunately, it means nothing anymore. I think everything now is speculative. So it's what others think it is, because you don't want to keep, it's not your company, right? So in high frequency trading, you don't care if the company succeeds or it fails. I mean, the company could burn and die and everyone, the whole country gets destroyed. No one really cares, but they just care that they can make money off in that time period. So it's all speculative.
Thank you.
No more questions? Otherwise, don't complain if later the coffee is cold. So thank you very much, Ramit.
No, thank you, everybody.
Paolo, very much.